Okay, time is 8:30. A very good morning to everyone, and welcome to our weekly capital markets tutorial. Today is May the 17th, and this is for the FC class. Welcome, everyone. May I just ask somebody, please, to unmute and just say a quick good morning so I know that I can hear you and you can hear me, please.
Morning, Sam.
Good morning, Xiaolin. Now, got lots to do today. Mainly, I want to divide into 3 different parts. I'd like to just quickly talk to you about convertible bonds. There's a lot that can be said, but today will be a continuation from last week when I tried to impress upon you the most important, the simplest question about CVs. Never mind all these structures and technicalities and hedging and delta placement and neutralizing your beta. Never mind all of those, okay? First question is, who buys CVs regularly? Okay, so that, and then I told you, hedge funds play a very significant role in the CB market, and there is an estimation that at least 35% or more would come from this segment. It used to be more, so it was a bit less after the global financial crisis. So without hedge fund participation, it is probably fair to say that a CB transaction probably cannot take off. Okay, so that is the reason we care so much about not just buying. We care more about partial hedging of a CB, far more than you would care about the partial hedging of credit risk when you are selling bonds, because bonds, the client base would not actually look like that. You sell bonds to all kinds of people, even governments and corporations, pension funds, individuals, retail funds. I mean, hedge funds, yes, some of them, okay, but the role that they play is nowhere near the role that they play in the CB world. So so this week, we're gonna have a look. We're gonna have another look then. So knowing that hedge funds are an important player in the CB world. So today we then look at what they do and how they do those things. Okay, so that is this one. The rest of the time I want to devote that to just a very quick coverage of some of the midterm questions, and this will be an opportunity and probably amongst the last opportunities for you to get some participation points. I'm going to be very fast. And when I read out a question, if you want to give an answer, go right ahead. Otherwise, I'll just push through because we don't have a lot of time, okay? But if you did not get a question right, this is your chance to make up for it. Just yell out the answer and tell me why, and I'll give you some. I'll happily give you some participation points. Okay, and then I noticed that you guys have also written to me with some questions, and Always very happy to hear from you, as you know, and I will go through those as well. All right. Uh, so in terms of housekeeping, so not much longer to go. So you do have a project coming up. It's called financing proposal. And after that, there is the assignment number 2 and also the final exam. So today we are here. This is you guys. And we are entering into, after this, we enter into week 10 and week 11. So this is where we start our presentation cycle, as you know very well. And then after that, we're going to meet on Tuesday morning 2 more times. For the last time, our last meeting, May 31st, I've actually invited the other class. They normally have the tutorial on Saturday morning, early Saturday morning. But if we were to do that, that means their tutorial would be Saturday, June 4th. That would be silly because the exam will take place in the afternoon. Right? So the last tutorial would be a combined session for everyone, which means it might be harder for you to get participation points because there will be a lot of people. So if you're going to speak up today and speak up next week. This slide deck, I think, may not be in Blackboard yet. It will be soon, but when it's up there, I'll put it up there today. So please just listen to me. You will find the lecture links are updated up to last Saturday for FC and also for FA. But you don't have to care about FA. And then, yeah, so I hope the projects are going well. So you do have to deliver a PowerPoint, but it's going to be a short presentation. We will look at the report, and that counts also substantially. Now, so all of this is old news. You should have a minimum 3 people speaking. You can have more. We leave that up to you, but no less than 3. We don't want to have just a couple of guys or just one person standing there delivering and then delivering the whole show. That's not group work. Okay. There will be a peer review. I'm going to send you a form after the whole thing is finished, and you can provide feedback. The way we do it is you can rank your colleagues, your teammates, on a scale of 1 to 5. So 5 is best, 1 is worst. The default response, which means if I do not even hear from you, excuse me, or if you simply want to give everyone a 5 out of 5, you don't need to do anything. Okay, so you do not need to respond to the peer review if you have been perfectly happy working with everyone else. But if you want to give a 4, 3, a 2, or a 1, then please use that sheet. And I will provide a link to that later on. And then the final score, there is a component which will be the peer review. And you have to, and then the peer review score will be adjusted for that component. All right. And you can see at the bottom here, I says most students award each other 5 out of 5. I got no problem with that. Okay. And genuine, we're fine with that. But this provides, in my experience, a very effective safeguard against free riding behavior. Yeah. So here's a list. And then for you guys, we already did a lucky draw last time. This is the sequence. So for this coming Saturday, it will be the top 4 teams presenting in this order. Okay. So please be ready. And then FA, like I said, that doesn't worry you. Now assignment 2 will be due. I try to give you as much time as possible, so that is due next Thursday. But your project, excuse me, your group project work, there's a deadline, okay, is actually due in 2 days for all teams, please. All right. Are there any questions from anyone? Everyone is quite happy. All right. Okay. Now, I want to go straight to actually your questions that is at the back, excuse me, of this slide deck. Now, we've already done this one, the one about rights issue. I just included it. We've done this one too. Why is it that people buy negative yielding bonds? Because they expect the yield to be even more negative. In finance, you must have realized by now that, and this is one of the fascinating things, there are certain things that actually in the long run, they don't make sense, or they don't make complete sense. But in the short run, maybe it does make sense. And trading bonds with negative yield is one of them. So if a bond is yielding minus 1%, if you were to hold that to maturity, unless there is serious deflation, that's a different discussion altogether. So you know how nominal interest rate, I hope you have all learned this, okay? Nominal is the rate that you see across the screen everywhere, is equal to the real rate plus inflation, right? So if you have very, very serious negative inflation, or if you have deflation, things are getting cheap, then your real interest rate is still positive. Now that can be another reason why people are buying negative yielding fixed income products. Okay, so that just means if you had $100 and you want to spend that $100 today buying something, but if you were to buy one of these bonds, or if you even just keep it as cash, then in 1 year's time, all right, if you buy one of these bonds, then in 1 year's time, your $100 actually just becomes 99 because it's negative yielding. So your money is shrinking, it looks like. But something that costs you $100 today, in 1 year's time, because of the negative inflation, will only cost you 97. So even if you buy a bond like that, and then you wait 1 year, you got your $99 back. So, oh my God, my money is shrinking. But if you then go out and you want to buy that same thing that you were thinking of buying a year ago, it only costs you 97 bucks. You still got $2 in your pocket. That $2 is that real yield. Okay, so that is one reason why negative yielding bonds sometimes get traded. The other reason, as I said, is, I mean, never mind the real and never mind all that. But if you buy a bond which is yielding -1, you buy it and then 2 weeks later it's yielding -2. Well, then your bond price goes up, and then you just flip it, you just sell it. Okay, that's what I meant 5 minutes ago when I said in finance there are some trades that they look like they don't make sense. You know, why are people doing that? And then but in the short run it's a different game. All right, now here somebody asked a question. Dear Sam, why does a CB have less negative impact on stock price? Now, this slide actually came from lecture number 7, page 32. I don't mind we just go there quickly and have a look. This is week number 8. Hold on. So week 7 is right here. Page 32. Oh, I'm gonna shut down one of the cameras to save to make the data more, the internet more efficient. Otherwise, it can crash anytime. Oh, how can I do that? Hold on. Oh, here we are. Okay, so I'm gonna stop the video here. Where were we? Oh yeah. So here now. So rationale of convertible bond issuance. So you have these, and then the question is why this? Oops. Less negative impact to stock price. Now, you got to look at it like this. And I suppose this is actually relevant to your discussion on the group project as well, because you are offering your corporate customer different choices in financing techniques. So let's compare it like this. All right. So the stock price currently is, let's just say $10. Now, so you are now, you want to raise you are the CFO of a company, and you want to raise some new money. Now there are many ways to do it, I know. So you can raise money in a follow-on offer, sometimes known as a secondary offer. I hate to say that because that's why I hesitated. Then you get confused with secondary shares. You're offering new shares. New shares gets new capital. Okay. So new shares. And then there are other ways. You can sell bonds, or you can sell CB. Now let's not talk about this for now. But let's just say your company has, 100 million shares in the market. All right. And now suddenly you just imagine, let's say you want to offer another 5 million shares. And when you do so, you would pretty much have to offer it either at $10 or perhaps even slightly cheaper. Even if you don't, I mean, economics 101 would tell us that when there is a lot of supply of something, the price goes down. So follow-on offer, unless the market is red hot, and right now it is not, you know that, unless it is red hot, or even if it is red hot, whenever you offer new shares, inevitably there is not only is there dilution, I mean, there is potential dilution with CBs too, but the additional shares would put pressure on price. Now, why is it that a CB doesn't have the same effect? Two reasons. Number one, a CB actually starts as a bond, So there are no additional shares in the market, not in that manner, number one. And then the CB typically, okay, maybe not so much in the Chinese market, but in the overseas market, typically the new shares are sold or converted, is probably the more appropriate word, are converted at a higher price. Now you imagine, so let's just say, so it can be anywhere from 25 to 40%. So let's say the strike is $12.50. All right. So you think about this intuitively from the point of view of an issuer. So first of all, you don't have this pressure, number one. Okay, and number two, if the shares are sold or converted, you can sleep well, knowing that those shares will be basically converted or subscribed, if you want a third word, okay, subscribe at $12.50. So it's not going to dip below 10. And if the share price doesn't get there, well, too bad. Then you just pay back the bond. So that's the reason. Is everyone okay with that? So a lot of these, they don't require formulas. They don't require you to read large pages of, dissertation or thesis or nothing like that. It requires you to think about these things. Is everyone all right? Dinkun, are you okay? I'm asking because you were the first name that I see on the list of participants. Is Dinkun there? Xian Dinkun? Is Hongjie there? Wang Hongjie.
Yeah, I'm here.
Hi. Does it make sense to you what I just said?
Yeah.
Sorry about that. Yeah. Does that make sense to you, Hongjie?
Yes.
Is it okay? Yeah, that's good. Now, let's go to the next one. I'm a little confused about top-up placement. I know it is primary, but top-up placement includes two steps. First is major shareholders selling shares to the public. And second is major shareholders buying those shares back from the company. Up to this point, it is completely correct. It seems like this top-up placement gets involved in both primary and secondary market. So is this placement selling primary shares or secondary shares or both of them? Okay, now that's an excellent. I don't blame you for getting a bit confused. Know that in finance, you can think of things from different angles. I mean, the two key ones are legal and economical. Okay, so economic. I think in the end, this one explains the motivation. This one explains the why of people doing things. This one explains the how of people doing things. Okay, so how the hell do you do a top-up placement? Well, you do it in the way that is described in this question. It's completely correct. The somebody wants to invest in a company, and that somebody is happy to buy new shares. However, in order for new shares to be issued and approved by the board, and then this and that, it takes a long time. So the major shareholders are thinking, well, how about I just share some of my stuff? So I'm not share. I sell some of I sell some of my shares to this investor who is very interested. And then at a later time, when all the paperwork is all done and all the lawyers have signed off and this and that, then I buy back from the company. So that's the legal part. So you are right, I think, to say that the legal part first involves secondary, because it is the existing major shareholder selling to the outside investor, and then it involves primary. From the legal point of view, that is correct. However, I think we ought to focus more on the economic, and why do you do that? And you do that in order to minimize any potential delay. And if you look at it from the economic point of view, this is principally a primary deal, okay? Because the secondary is purely just a legal distraction that you must go through in order to arrive at here. Okay, that's how I would look at it. All right, is everyone okay with that? So first, you have to understand what is a top-up placement. Please know these things, because regardless of whether you end up on the buy side or sell side, at some point in your life, if you are in capital markets, you are going to be involved. Okay. Now I'm going to go quite fast. So if you have questions, do not hesitate to stop me. Okay. Another one. Hi Sam, I have a few questions regarding the material of CMT and D. Okay, don't worry about DT derivative trading. We dealt with that elsewhere. Regarding week 7, it's week 7 again. The value is the value of parity equal to the conversion price times the shares that the CB can convert into? You're nearly correct. It's not the conversion price. What price is it? Does anyone know?
Should be conversion ratio times the market price of the stock.
Thank you. Did you see what was that Jialin?
Yes.
Did you see what I did just now in front of the camera? What did I do?
Thank you.
Excuse me. It should be just the spot price. Okay. I tell you what parity actually means. It is a very simple idea. Okay, don't be frightened of it. So you all right, we'll use that example that I mentioned earlier. So that the shares are now trading at 10, and you issue a CB. So now, so CB has a face value of, let's say 100, doesn't really matter. You buy the CB at par, but it's convertible. The conversion ratio is 8, okay? So convertible to 8 shares. Now that implies that the strike is actually just 1250. It's 100 divided by 8. So you have bought a bond which contains 8 little call options, each with a strike of 1250. But let's say a few weeks later, the share price is now 15. Okay, let's make it a bigger number. Let's make it 25. So there's a massive jump in the share price. Maybe they became a takeover target or something. So the parity value is simply, as Jialin was saying, your conversion ratio multiplied by the price at that time. So it is just saying, if I am an investor in this CB, and if I convert it now, and no one is saying that you must, perhaps you can't even do that. It's got nothing to do with it. Sorry, I'm just making some notes about class participation. So no one is saying that you must, but if you were to convert, then at that moment in time, the conversion, after conversion, your holdings would be equivalent to $200. Okay, so that's what parity means. So don't confuse this with, you know, put call parity or you know, $100, that parity. Okay, everyone okay? Now, second question, how to calculate the accreted value of CB and what is the use of the accreted value? This is in week 7, slide 15. Slide 15. There is a slide regarding accreted value. Now, this one, I suspect actually that there may be a typo, but I think it doesn't matter. I think this should be 2021 thing. Okay, just 1 second. Okay. Hello. Hi, sorry, I'm in a class. I'm in a class. See you later. Bye bye. Yeah. So now, what is accreted value? Now, if we were to look at this case, this is what we call typically an example of a premium redemption, which is you pay $100 and you don't get anything until at the end, when you get a whopping big redemption amount. But that assumes hopefully the issuer does not default, of course. And I think it's seven years. So after 7 years, you will get $121. Okay. Now, where does this $21.07 come from? It's just compounding what we call the back-end yield, the accruing yield, semi-annually, 14 times. You will get this. Okay. Now, know that for any bond, for any fixed income, so there is, I mean, this is really an example of a zero coupon bond. Now, zero coupon bonds typically start from, let's say, you know, 92, and then you accrue, you climb back up to 100, and then they pay you back par. That's an example of a simple pure discount instrument, but it's really just a matter of scaling. So here we don't start at 92 and it grows up to 100, but here we start at 100 and we grows up GROSS. grows up. We grows up to 121, 121.07. Now you must know that in fixed income, so this is 7 years later. First of all, this is not a straight line. This is your destination. This is your origin. It doesn't go like this. Number one, okay. First of all, it doesn't go like this, but the accrual would be gradual. It's non-linear. I mean, you must know that bond prices, so it'll slowly grow like this. So depending on what day you are, if you just read it off this graph, this line is a series of accretion value. So I think somewhere around Jan 27, 2021, your accretion value would be like this. And if you don't believe me, if this bond was issued at in January 2016, that's exactly 5 years later. So if you were to compound $100, 2.75 divided by 2, if you were to compound that 10 times, you get a value very close to, I don't know why it's not, I already tried it, it's not the same as, but it's very close, okay? So there may be some rounding because of the date error, but it doesn't matter, okay? My point to you is this is the accretion value. Now, when you are pricing a bond, of course, you know, when you start, this is the yield that you are promising someone, but during the lifetime of the bond, the actual price of that CB, regardless of what the call option is doing, okay, the actual price will likely be up and down like this. So the only thing you can guarantee is that at maturity, it will come back home. That's if the issuer does not default, okay? It's it's a little like this. Okay, let me ask a simple question. So this is Hong Kong. It's got nothing to do with bonds, but it's interesting. This is Shanghai. Okay, so let's say there's an aircraft that is flying from Hong Kong to Shanghai. So there will be a navigation path, and you know the computerized. So you enter that into the computer, and the aircraft navigation system will be able to figure it out. But let me ask you a question. How many percent of the time do you think the aircraft is actually on course? On course means it's actually following this line, this straight line here. So if it's off course, it's kind of doing this. So how many percent of the time do you think it is on course? Would someone like to make a guess? Of course, you don't know the answer, but just for fun. Is Jiarui there? Jiarui? No. How about Jingxin, Chen Jingxin?
Yes.
Good morning.
Good morning.
How are you?
Hi.
Do you understand my question?
Yes. I guess maybe 40%.
40%.
Mm.
So 40% of the time it will be on course, and the rest of the time it's kind of a little bit off. That's your guess, right? Now it's just a guess. Of course, you don't know the answer. I'll tell you the answer. The answer is 0. It never is exactly on course. And you can talk to people who are in the aviation business. It tries its best, but it's always just back and forth. But many of you have flown, I'm sure, from Hong Kong to Shanghai, and in the end you get there, right? So it's not a problem. But I use this example to demonstrate to you that so the accretion, the accreted value is just a way of saying, look, this is the original schedule, or this is the original navigation path. But unless at any moment in time your discount yield is the same as your original pricing yield, unless that was the case, and most of the time it isn't, and because it isn't, then your flight path is just going to be, you know, bopping up and down like that. Okay. Actually, I use that example just for fun, but now I realize it's actually a good example to help you understand, I hope. Yeah. Is everyone okay? Jerry said 50%. Oh, sorry to disappoint you. It's closer to 0. Anyway, it's very low. I don't know if it's exactly 0. It's never exactly on course. All right. What's next? Oh, I think that's it. There is one more thing that I think I should draw your attention to. Now, somebody, while reviewing the notes of week 8, somebody was reading the notes very, very carefully, and I really appreciate that so much. There's a graph. Oh, here we go. There's a graph in here, and this is a graph regarding a call spread. And so now if you issue the CB, then from the point, so you have to ask yourself from the point of view of who are you talking about this? So from the point of view of the investor, I mean, this curve is certainly correct. Okay, so you have unlimited upside, but this blue line here, from the point of view of the issuer is actually short a call. So strictly speaking, originally when you are short a call, then you are short, and then you are short a call spread. So the call spread short position should be a mirror image, and therefore the blue line should also be flipping down. So I agree with that. But whether it's flipping down or flipping up, I think the key point is to understand, you know, why it is changing direction. Okay, so flip up, flip down is just something with a minus sign in front of it. So that, for me, that worries me less. But you know, the key is, do you actually understand why it should flip down? And that is because you are short. You are short the original. You are short the original the call, which is this one here, and then but you are long. You are long another call at a higher strike. So therefore, when you add it all together, you are short this. This is your effective call profile from the short side. Okay, so it should be flipped downwards. Now, how are we doing for time? 9:17. Let me very quickly just, so as I said last time, I told you who would buy CBs. So today I want to just tell you a little bit about this is a quick recap. Now, you know, this is what a car looks like when you take it apart. Okay, I mean, don't try this with your own car, but this is all so you got the seats, you got the wheels, and then the most important part, you got the engine. So you can take a car completely apart and put it back together. And I know someone who actually tried that one. That was his hobby. Okay. So when you are trading financial instruments, quite often it kind of looks like this. And in fact, you know that there are merchants out there who would just specialize in tires. So they just change your tire for you. And there are some who would specialize in customizing the engine and so on. So CB trading, now a CB is simply a bond plus a call option. So if an issuer XYZ, let's just say if they issue a 5-year straight bond means just plain vanilla. Maybe they should be paying a 5% coupon. So this is a 5% coupon. Ordinarily, okay, no call features, nothing, just a simple bond. But now they sell you a bond. That bond will come with coupons, but you also get a call option on the back of that. So maybe they don't give you 5, they just give you 3. So this is 3%. So where's the other 2% gone? Well, they don't give you that, but instead they give you a call option. Okay. So if you understand what I just said, that's it. That's a CB. So it's such a simple and such an elegant instrument. Although that's what a CB is. I mean, understanding the market, I mean, that's a different matter. So understanding how you can make use of this 2%. So they're going to pay you a lower coupon because you are compensated elsewhere. Now, the call strike of I know this is not the case in the Chinese market. I know that. So they're closer to the money, sometimes at the money, even in the money. And there is now, do not confuse the CBs that we've been discussing with those 81, which are contingent convertible bonds, because for those, when you buy one of those, the right to convert is not in your hands. Okay, I think this can be an interview question. If you claim to have worked in financial markets, or if you know something about it, I will ask a candidate, what is the difference between a normal CB and a contingent convertible bond, a COCO? What's the difference between a normal CB and a COCO? Okay, so COCO actually is a bond, but you have sold. You means you are the investor. You have sold. You haven't bought. When you buy, there's a plus sign. You have sold a put option to the issuer, okay, who will be compelled to convert your bond into stocks when things start to go wrong. That's why there's a put option. And that exercise, that conversion, is contingent upon certain bank capital events. So it is actually a knock-in. So this is the way to understand that. Okay. There is, or some issuers have issued a convertible contingent convertible bond. It's very unusual. I just put that there for interest. If you are curious, look up Bank of Cyprus. A while ago, Cyprus, they did such a deal. Okay, I'm not going to talk about that here, but it was quite an interesting trade. If you are curious about that. Now, so let's go back to just normal, good old-fashioned CBs. It is bond and call option. Now, you can decompose the bond part. So right now, I have kept the call option same. So the bond is just the risk-free rate. Typically, if it's the American market, then US Treasury rate plus the credit risk. You can split that further if you want. So there's a real interest rate risk. Just like that equation I was showing you when we were talking about negative yielding bonds, plus inflation. So I've split this into these two. The rest I have not touched. Now, the thing is, the call option actually can be broken down into a number of exposures. And because you are all doing derivative markets, I'm not going to waste your time here discussing, but you should know that a call option has several components. A call option is still exposed to the market to various degrees, depending on whether the option is in the money or out of the money. There's convexity and there is volatility. Okay. So now that you know, when you buy a CB, it's just like when you buy a car. It's a package of a whole load of things coming together. But you wouldn't buy a car in order to trade the engine or trade the tires. I mean, I know you wouldn't, but imagine that you can. Imagine that you can. Okay. This is the same here. So there are CB managers who would buy a CB hedge funds, I should say, a CB hedge fund who would buy a CB, but they don't want to trade, or they don't want to need to worry about profit and loss as a result of changing credit risk. Maybe they don't want to worry about inflation or even interest rate risk. So you can hedge all these if you want to. You can hedge these. So end up, you are just left with the option. Now, so typically, hedge funds don't want to need, because if you have risk on delta, it means when markets go up and down, you're going to get distracted. Oh shit, I'm losing money because the market goes down, and then the next day, oh, I'm making money because the market goes up. You just don't want any of that, because you want to focus on these two. Therefore, you want to short shares in order to get rid of this. Okay, now that is the reason we talk so much about delta placement and neutralizing your market exposure, because hedge funds are a big buyer of CBs. So you actually need to help them. You need to help and then one thing that drives whether hedge funds are interested in a deal is how easy it is for them to hedge the equity risk. Okay, so if it is very, very hard for them to hedge the equity risk, then their interest in this deal will be much less. But if it is easier for them to hedge and you tell them that and they know that, then they are likely to be more interested. Okay, so I think it's quite important to understand what I just said to you, because if you understand that, then when you read the lecture slides, a lot of the slides will now start to make sense to you. Oh yeah, why are they trying so hard to help the hedge fund and providing the and lending the shares for them to short and this and that? Why are they doing that? And then doing it in a package and calling it a happy meal. Why do that? Why? It is because they want to, excuse me, they want to help the hedge funds to hedge the equity delta properly. All right. So here are some relevant questions to think of, and first one we already answered. What type of risk participation do they like? Well, we've answered that one too. I think one thing to think about is if you are an investor, especially if you are a hedge fund, I mean, you have to take some risks. You don't buy a CB and you start hedging away everything. Then what your client is going to ask you, what is the point? Then what are you doing? But at the very least, CB hedge funds will buy a CB and get rid of this. So that you can tell, because they don't want to be distracted by the random ups and downs, and sometimes they can be extremely volatile, as we have seen recently. They don't want to be distracted by the ups and downs of market from day to day. Whether they actually hedge this, or even this, I think that's up to the individual hedge fund, but most likely they will hedge at least this part. Okay, so that is bullet point 2. So how do they segregate and trade only the risks they want? Well, you're going to need all kinds of derivative instruments, such as treasury futures, or inflation swaps, or credit default swaps. But mostly you need to short the shares. Okay. Do you know what is the bond floor of a CB? Who can tell me what is a bond floor? Quickly, guys. Is Kakit there? You Kakit? How about Luo Qi?
Hi.
Morning. Trying to give you some participation points.
Okay, the bond floor means the minimum value that this convertible bond should trade for.
How do you define the minimum value?
Well, usually from the discounted present value of the bond's coupons and its conversion value.
The conversion value. Okay, that's not exactly it. By the way, every question that I asked you, try and pay attention. I don't know if it will come up in the final, but there is a likelihood. Okay, I haven't seen the final yet. Bond floor is this. Thank you for that, Luo Qi. Okay, I'll give you some points, even though it's not exactly now. So I said to you, the CB is a bond plus call option. So when you buy a CB, let's say you pay par. So at least in theory, you should be able to work out how much the call option is worth. You have all the parameters. Okay, tenor, 5 years, volatility, 37%, strike, 125, or whatever. So let's say the call option is worth, I don't know, $12. That must mean the bond itself is worth 88, at least on the day when you issue the bond. So every single minute it will change, okay? But at that point in time, you determine as much as you can that the call option is worth 12. And so therefore it implies the bond is worth 88. Bond floor is this number. So the bond floor is just the bond component of a CB, in other words. Is that okay, Luoqi?
Yes.
Do you understand that now?
Yes. Thank you.
Is that okay? All right. Now, now final question. So if a CB is simply the bond plus a call option, which it is, I mean, what is so special about the call option in the CB? I mean, what is the big deal? Well, you can ask the question in another way. Okay, I'll show. I'm just. We'll come back to that. We'll come back to this question in a couple of minutes. Okay, what is so special about the call option that comes with the CB? Okay, and the answer actually is very simple. But here is a table. I don't know if you're going to need that in your final exam, but you are allowed to open it up if you want to later on. So it just, when you are issuing, at the point of issuance, how various aspects of your CB will influence the coupon level. So, for example, if it is very hard for investors, principally hedge funds, to borrow stocks in order to short sell, if it is very hard, then when the stock borrow cost goes up, then they will ask for more compensation. So there is a positive correlation. If this goes up, then the coupon rate goes up. So or if this goes down, you can, if you are the issuer, you can pay less coupon. So the lower the hedging cost, the less coupon compensation is needed. So this is how you read it. Okay. Likewise, if some investors want to hedge the credit risk, and like I said, they don't often do. But if you're talking about CB hedge funds, most of them will want to hedge out this part. But if the liquidity is very good on the credit default swap, then you can pay less coupon. But if liquidity is very poor, then you're going to need to pay more. Okay. So the lower the hedging, the credit risk, a low hedging cost for credit means a high degree of liquidity. I'm sorry if this is a little bit upside down, but you just need to be, don't memorize this table. Okay, read it, understand it, and you will be able then to write a table like this on your own. I wrote this one on my own. Okay, so you will be able to do that. Don't memorize it. Okay, you're gonna forget it in 2 weeks. All right. Now, so how do hedge funds actually invest in CBs? as I said, they do not just buy and hold. There are funds that would do that, but they don't. So what are they trading? So often they like to take credit risk. Sometimes they don't, okay? But the key point of hedge funds buying CBs is to trade the volatility. And this is what being market neutral is all about. Okay, so I don't care whether the market goes up or down. I really just want to trade volatility, and mostly I want to trade volatility from the long side. I want to be long volatility. Okay, and in order to do 1 and 2, you have to be able to short sell the underlying stocks to make it delta neutral. Okay, we have plenty other forums where this is discussed extensively, hopefully in derivative markets and also derivative trading. If you are unclear on this delta neutral stuff, by all means let me know, and we can go through it, but I won't do that now. Now hedge funds actually trade CBs this way because the so-called classic way of CB investing, I mean, there are mutual funds that do that, and if you just have a portfolio just full of CBs and there's no hedging, then as the market goes up, your portfolio value will go up, and as the stock market, as the stock market goes down, then your portfolio value will go down, even if it is doing it in a non-linear way, okay, like in a curve. But hedge funds don't do that. Last question. It's the $1 million question. So you've seen all these deals. The question I'm asking is, why not, if hedge funds love to trade corporate options so much because of the volatility exposure, which is the key exposure they take, if they love that so much, why not just trade the call option directly? I mean, you know, with all these notes and all these deals that we show you, all of these, why spend so much time with the CBs? Why not just go out there and buy the call option? Isn't that easier? And a lot of deals here, I mean, this one, for example, it's a 7-year trade, 7 years CB, 0 coupon, comes with a call option. This is another one. This one is negative yielding. FX link. So why not just go out there and trade the share option? Is Zibing there? From Zibing? How about pacing?
Yes.
Good morning. How are you?
Morning. I'm fine.
Do you understand my question?
Yes, but I do not know the answer.
That's okay, but don't you think that's a very important question?
Yes,
You understand what I'm asking you, right?
right.
So first, I'm saying that hedge funds love to trade CBs because they love to take out. It's like some people love to trade cars because they love to take out the engine. That would be a crazy thing to do. But then why not just trade the engine? That's the question. Yeah.
Yes, I know the question, but
Yeah.
I
Now
do
the
not.
answer is very simple. The answer is those options are not available. That's why. So you take a deal like this. All right. So this is regarding China overseas. 688 is a stock code. So this is a 7-year CB. So it comes with a 7-year equity call option. And if you, okay, I apologize for that. It was an urgent call I was expecting, but I'm asking them to call me back in 45 minutes. Now, back to that question. The reason that you don't trade the options direct is you can't find. I challenge you to go out there and find a 7-year call option on China overseas. It's not available. Okay, which is why hedge funds love this kind of stuff, because it allows them to trade call options on names that may be relatively unknown, number one, for a long period of time, number two. Even if you were to go to a platform like Morgan Stanley or UBS and you say, can you make me a market for a 7-year option on China overseas? It will be extremely expensive. And then if you want to get out of it, once you buy that, if you want to back out, you only have one party to play with, which is the party you bought the option from. So that is why, that is the functional connection between CB and volatility risk participation. Okay. Now I have some notes here on what a call spread is. I think I'll just let you read it later on. It should be quite simple, and there is even a trade that was a real classic involving a company called Symantec. I don't know if they're still running, but these guys used to be in antivirus software. All right. Now, so that is all I want to say on CBs today. Are there any questions from anyone? So I'm going to use the remaining time to just talk a little bit about the midterm questions. So let me just open that up. Okay, here we go. Now we got up to question 12, I think, last time. So I'm going to start at 13. And I will try and go as far as I can. Give me a second. So I will show you question 13. Now you have a look at that, and if you want to yell out the answer and give me an explanation, I will give you some participation credit. Who wants to try for question 13?
Should be C.
Is that Jialin?
Yes.
Thank you, Jialin. Why is that?
Because for the second option that encourage employees to for more insider trading must be wrong, and so we cancel all the second option that only left C.
Very good. Yeah, sometimes that's the efficient way. So just find the exceptions. Thank you for that. You are right, and I have noted that contribution. 14. Now I'm going to read out the question, and I will wait for a few seconds. If anyone wants to answer, just unmute yourself. Otherwise, because we're running out of time, okay? But if you want to grab some participation credit, please do so. I got a message. So when you have a question, please just ask. I mean, don't type. I frequently miss them. Okay. Do we have a word count requirement for assignment 2? No, it's just the same as assignment 1. This is not the kind of assignment where we need to impose a word count, because those questions, you can be very sensible. You're not going to write 5,000 words when I just ask you about the structure of an IPO. Okay. Okay, question 14. What do sponsors do in the IPO process in Hong Kong? A sponsor in the IPO context is not the same as the sponsor in like a sports event, or I mean, your parents are sponsoring you, I assume, in your Master of Science degree. So that kind of sponsorship means they actually pay something. Here, the word sponsor has a different meaning. Here, the sponsor basically is the leading bank in charge. The one who is in charge chiefly of all the documentation and distribution, marketing, roadshow. That's the sponsor. What are they responsible for?
I think D. D.
Is that Yifan?
Yes.
Why is it D?
Because that's what I learned in the class. That's it.
Well, don't say that to the manager interviewing you. They do that. These are all the responsibilities of the sponsor. Actually carries, a big weight in terms of the whole transaction, conducting due diligence. The sponsor is to some degree even criminally liable for any errors and negligence. Preparing documents, ensuring that compliance is observed, and then going to the issuer to attend meetings, and even taking them to roadshows everywhere. Okay, thank you for that, Yifan. 15. I want to get up to at least 25, if not more. So which of the following information can be found in an IPO prospectus? Okay, the correct answer is A. You will not find research reports. I mean, that's ridiculous. But you do find description and financial statements, and also the key managers, the key personnel, and what they do. You do find that. A few years ago, there was an IPO of PCCW, I think. So the telephone company in Hong Kong, and it's not a secret. So this was a famous case where the IPO stated that one of the owners, Richard Lee, the son of Li Jiacheng, he claimed that he graduated from Stanford. So that's what it said in the in the IPO prospectus. But you know what? Actually, he did not graduate. He just went there, but he gave up halfway through. So people were threatening legal action. Say, hey, look, your prospectus contains a material misrepresentation. This guy, you know, you should not use the word graduate. So you got to be very careful that the information is correct. Okay, number 16. In an underwriting agreement, underwriters agree to take up any unsold shares that are not purchased by investors. What is that called?
A, soft underwriting.
Who's that? Who spoke?
Pai Xing. I
Okay.
think it's B.
It's hard underwriting. Okay. So someone else spoke and said it's soft underwriting.
Sorry, I want to say B, and I say it wrong.
No problem. It's okay. This is not a competition to be right. We are here because we don't always get things right, and then we learn and then we get them right. It is hard underwriting. Soft underwriting, I think, is the process where for any unsold shares, the broker will say, okay, I understand. We're supposed to sell 1 million shares, and now there are 100,000 left. So we will get those shares from you and turn around and try to place them in the market as you know, as soon as possible. That is soft underwriting. So they're still trying to help the issuer, but hard underwriting. Okay, we can't sell this amount. You buy it, and you give us the same price. Okay. Now 17. In an offering, the issuer has the option to increase the issue size from the base size. This is called, I'll be quick. Okay, does anyone know what this is called?
Over allotment or green issue option.
Very good, Ivan. This is called the over allotment option, which of course leads to potentially the exercise of the green shoe. And at 15%. Okay. Now, number 18. Which of the following are correct regarding IPOs in Hong Kong? There is a Hong Kong public tranche. There is an international placing tranche. Yeah, you know, like I have said so many times, it's probably better to call it the retail tranche, the mom and dad tranche, and then the professional or institutional manager tranche. The international placing tranche can be purchased by China Life Asset Management in Hong Kong. So that's not international, that's local, but it's institutional. Okay, so it's just the retail clients and the institutional clients. So one actually is correct. Shares in the public tranche are clawed back to the international offer tranche if international tranche is oversubscribed. Is that true?
No, that should be wrong. That should be in the opposite way.
Exactly. It's the it should be the other way around. So two is incorrect. There's always a lockup period for issuer. Yeah, that is correct. So the answer is B. Okay, so 1 and 3. Now 19, the listed entity, we'll go up to 20 and then I'll let you go. Okay. The listed entity is an offshore holding company injected with China domestic equity or assets to achieve an indirect overseas listing. This structure is called a what?
Should be a ratchet.
Who is that?
Jialing.
She's grabbing a lot of the participation points. Okay, it is a red chip. So a red chip is any company that has a Chinese background or Chinese capital, but is incorporated outside of China. Okay, and there are many examples. In Hong Kong, a structure whereby an entity established in the PRC that is wholly or partially owned, foreign owned, exercises de facto control over a PRC domestic operating. It sounds like one of those Alibaba jobs or Baidu, which holds a necessary license. Yes, it is that. So by virtue of various agreements, the foreign entity obtains de facto control over the operation and management of the PRC domestic company. If ever you get confused with this very, very wordy paragraph, think Baidu or Alibaba. Okay, what kind of structure do you call that?
VIE structure.
Very good, Xin. Ask you one more thing. What does VIE stand for?
The provide interest act. No, equity entity. Like.
Sorry, what's the first V? What's the V stand for?
I forgot.
It's okay. It's okay. That's what tutorials are for. Okay, it's not viable. You hope they're viable. Okay. Variable.
Variable. Okay.
Interest. Entity. Again, Alibaba is one such famous example. Okay. All right. Well, I was hoping to do more, but maybe we can carry on next time. Do you have any questions on? Thank you for that, Pei-Xin. On anything else?
Yes, Sam, do we have to sign up the attendance on the blackboard?
Oh, yes, please do. Until 10:30, I think you can sign. Let me kick that off. Thank you for asking. Hold on. I thought I made that available. Hold on. In the attendance folder. Yes, I already prepared the attendance for today. You can sign that now. Okay. Are there any other questions from anyone? Otherwise, I thank you for joining me, and just a few things. So first of all, your group project is due on Thursday, please, and your second assignment is due next week. And third thing is that 4 teams will be presenting this coming Saturday. So you know, I think you know all that. All right. Thank you, everyone, and have a good day. It looks wonderful out there. It's a blue sky finally, and it looks pretty good. I'm gonna go out for a walk. Okay. Take care, everyone. See you soon. Bye for now.